What's up everyone? Welcome to another video. I want to get into my strategy. Strategy is everything in trading. How you trade is extremely important, and it's extremely important that you understand how the markets truly work to extract as much money as possible. The important thing to note about my strategy is that number one thing is you don't need to spend hours learning technical jargon. You don't need to know what a long-legged doji candlestick is, what a morning doji star, what all this bullshit is, because it's not important. They want you to think it's important. Other traders want you to think it's important. The only other thing that I will note is bullish and bearish candles. They do have significance because we need to understand how traders are getting manipulated into the market. There's a lot of jargon and patterns and just things that we don't need to know. I want to keep this simple for you. You've been learning things all wrong this entire time, and I'm going to flip that around. Let's get into it. Another thing, a big misconception about trading is you need to stare at the charts for 8+ hours a day. A lot of the time, I'm trading for 1 hour or 2 hours, absolute maximum. I prefer and I love the New York session, the first hour of the New York session trading gold. I also trade the first hour of the London session trading gold. Now, if I don't have a setup, I'm off the charts. If I jump into a trade, I'm off the charts. Why? Because once I've made the decision that I'm in a trade, I cannot control the outcome. I cannot tell the charts, you need to go up, you need to go down because I'm in a trade. No. So you need to stare at the charts for as little time as possible, make a good, smart decision, and move on with your day. Because what happens next is not important. And it's not going to help you sitting there for 2, 3, 4, 5, 8 hours, 10 hours, 15 hours. I've heard of traders doing this. People come to me, I'm trading for 18 hours a day. Why am I not profitable? And I said, because you're trading for 18 hours a day, less is more. 1 or 2 focused hours is all you need. Now, instead of doing these things that I've just spoken to you, I follow a simple 4-step system. It allows me to have complete location and time freedom. And it allows me, most importantly, to live the lifestyle of my dreams. I follow a simple 4-step entry model system. Now, this is 15 trading days that I did as a challenge. And on this challenge, I trade gold, Euro USD, and GBP USD, where I turned $1,000 into $10,000 to show the profitability, the skill set, and that you don't need a lot of money to become a profitable trader. Now, I just want to say a quick disclaimer that I am not a financial advisor. This video and all content on this YouTube channel is for educational and entertainment purposes and should not be considered financial advice. Trading does involve risk, including the potential loss of investment. It's not suitable for all investors. There's no guarantee that any strategy, indicator, or information presented will result in profits or prevent losses. If in doubt, consult a qualified financial professional. Now, it took me 4 years to make money as a trader. 4 years of doing the wrong thing. You may be in the same situation, maybe in year 1, year 2, year 3, year 4, year 5, year 8, and you're still in the same situation. I'm telling you now, I can cut these years down because I was looking for a quick and easy way to make money. I was looking for a quick and easy way to get rich. And everything that I was learning was wrong, but it led me to discover a lot of things about the markets, which is why I trade the way I trade now. And when you learn this, you can never unlearn it again. It's the last strategy you will ever need. So if you want a quick and easy way to get rich, click off this video because there is none. However, if you want to put in the work, a solid 2, 3, 6 months to learn this strategy, you will become a profitable day trader and you will change your life. But you won't want to watch this without me telling you who I am. So let me go through that right now. Firstly and foremost, founded FundedX, one of the fastest growing prop firms in the world, in October of 2023. 1st of October 2023, we're almost 2 years into FundedX. Amazing company. We have an amazing team growing the company as well. And it's been a pleasure to see the growth and be a big part of it. And, you know, it's an amazing company where, you know, if you're going to request a payout within 24 hours, it's in your account. And not many prop firms can say or do that, but FundedX can. And if you're just going to follow the simple rules, you're going to get paid and you're going to be very happy. I've been trading for 8 years myself. So like I said before, it took me 4 years to be profitable. I lost $250,000 in the process of my own money, put myself into 6 figures of debt. So you don't have to. So I will explain exactly how you can do it without losing any money, without hindering yourself and putting yourself years back. Because losing a lot of money will put you years back because you're mentally going to be messed up. And I was messed up. I had to figure out a way to make it work. I did eventually, 4 years in. It should not take that long for anyone. However, I had to go through what I went through so that I could be here today And now I can pass this knowledge on to you. First thing I want to explain is my trading strategies. I call it the liquidity trap method. And mostly I trade it on gold. However, this works on any markets. This works on currencies, futures, stocks, FX, crypto, everything it will work on. That's the beauty of understanding the true movements of the markets. But you might be asking me, why did I choose gold? Firstly, it moves very fast. Gold is super volatile, so trades will play out quickly. You get to quickly see if you're right or wrong, and I like that. Like, I'm someone that loves life. I'm someone that loves enjoying things like being in the sun, being in the pool, go do something, have some shisha, go to lunch, go to dinners. So I want to know quickly, and a specific period of time, if I'm right or wrong. Then it allows me to just continue with my day. If I make money, cool. If I lose money, cool. If I hit a break even, that's also cool. But at least I can know whether I'm right or wrong. Again, bringing back to what I just spoke about, it'll tell you quickly if you're going to have a win or a loss, which I love. It suits my personality style. Also, it's very manipulative. So we'll often fake out retail traders at key levels or entice traders to all get into a trade in one direction at the same time. And that's exactly what we want to see. So here are the 4 steps of this strategy. And I will show you real trading examples so you can understand it easier further in the video. First, let's get into the strategy itself. We want to understand the market context. Are we bullish or are we bearish? Again, this can be on multiple time frames, starting from the weekly, daily, 4 hour, 1 hour. We want to find out the overall direction on a higher time frame and also your overall intraday direction. Again, where majority of traders are looking for trades and looking for price to go. If we're in a bullish market, everyone's looking for buys. If we're in a bearish market, everyone's looking for ways to sell. So again, first thing we're going to do, check the weekly and the daily chart. So I'm looking at gold. Is gold trending up, bullish, or down, bearish? Again, I'm doing this because I'm trading against the majority, but I want to understand where the majority of liquidity is looking for trades. Again, if we have a big bearish break and prices retraced, a lot of people are looking for sells. That is a good example and showing me where the liquidity lies. It's at the high of the range. It's for price to make a high and take out all of those sellers at once. So again, we're going to step down time frame by time frame, daily, 4 hour, 1 hour, 15. We're going to look for what our structure is telling us. Again, if we're seeing 15-minute bullish, we're coming into New York session, everyone's looking for buys, we have a retracement, we know that a lot of traders are buying, that's when we look for a sell. So again, looking for the bullish or the bearish structure to tell us where the majority of traders are going in our trading sessions. So we want to mark obvious liquidity zones. So above and below equal highs, resistance levels, support levels, supply and demand zones. A lot of people don't want to tell you this, but they are all liquidity areas. If we understand that they're all liquidity areas, we have a buildup of liquidity areas, meaning a support level, a demand zone, a trend line, all in the same area. We understand that by taking that out, all of those traders will be stopped out of their trades. So step 2, spotting the target zone. What do I mean by that? So if price is coming back up to a supply zone, after a bearish structure break, we know that traders are looking for a sell there. A lot of traders, because not only is it supply, but price would have done a sufficient retracement within the current trading range. So we have Fibonacci areas. We know that there might be a resistance level. There might be equal highs above. It's all liquidity that we are looking to take out. Majority of the time, actually grab above that supply to take all of that liquidity out. And here's a good example as well to the right, where we have demand zone, where price is tapped into. But again, what we're expecting is price to actually break through that, given the liquidity that's in that area. Now, again, bearish example and bullish example here. I don't have to explain it, but bearish, it's the same thing. We have price coming back into a supply. Majority of traders are expecting price to continue lower. However, what we expect is that given the fact of the liquidity, especially we have equal highs sitting right here at that supply zone, that price will actually go to take that out. Now, what we want to see, again, is a trap reaction. So again, a double bottom, trapping traders in, giving us a fake breakout, or a double top with a fake breakout. Again, fake breakout to the upside. We have bullish break. What do we see next? Price makes a bearish breaker structure. Why does it make a bearish breaker structure? Because if prices make a higher high, a lot of traders are now looking for buys in the demand zone or at the low or after a sufficient retracement in the current range. Then for us, we look for a trap reaction in that area where we can then look for a sell to take that range low out. And it's the same thing in a bearish example that has a bullish break afterwards, of course. But if we're stepping down bearish and make this low, we have that number one, we have that lower high, and then a lower low, which is number two, before making a higher high to the upside. Now that higher high is where we're looking to target because we have bearish structure. So we have a supply zone at that top where we have that green dotted line. We know that there's a lot of liquidity sitting above that high. We look for a reaction from that supply to then take that out. Beautiful. So step three, again, the false breakout behavior is where we can actually enter a trade given the fact that we've taken out the liquidity from a low. And we can simply target the range high. Again, taking out all of that liquidity or waiting for a reaction, like I said before, at that supply zone. So there's several ways we can actually get into that trade and make a lot of money. So again, a small internal structure break will be the main move. So again, a 1 minute bearish break during a retracement up is going to entice us to get into a buy because now we have a small 1 minute range. We have a new supply zone created where that 1 minute breaker structure has just been, and that can get us into a buy to target all that liquidity and make money. And again, we want to enter against the crowd. So here is an example where the majority of traders are going short. What we should be thinking is that the money is above those traders' stop losses. So us, we're going to actually go long, take all their liquidity out and profit from the markets. So what do we look for? If most traders are selling at a supply zone, we can see this. We buy either into the supply, through the supply, or after a reaction from that supply. That reaction could be a bearish breaker structure or anything else that entices traders to go short, such as a big candle and a wick to the upside on the 5 or the 15 minute. That is when we buy. We buy through that liquidity and take that all out. So again, the opposite example, most buyers are buying at a demand zone. We sell not even into the demand, but through that demand and take all that liquidity out. So it's important that we focus on consistent small wins rather than high risk to reward setups. And that is why I'm using the 1 to 2 risk to reward ratio, because my win rate is over 50%. I know that a 1 to 2 can happen very quickly. And I know that based on my strategy, it's a very simple way for me to trade. I don't have to manage my trade much. I don't have to take partials and anything like this. It's a quick 1 to 2, it's done. I move on with my day, I'm happy, and I go and live my life. That is the goal of a trader, not to sit at a screen for 8 hours a day and just be going all these different trades, trade management, 2, 3 trades. No, one trade, one session, one pair. That's all we need. Always using tight, predefined stops for safety, of course. So now let's see a real trading example that I personally took so you can learn exactly how I went about this trade. All right, guys, so I want to show you a live trade example. A live trade example, which is a perfect reflection of this strategy itself. So without going too in depth on the higher time frames, let's focus on 4 hour and below just for this example, just so we can get through this because I have more stuff to tell you after. But here we have 4 hour, do a big bearish push to the downside, big bearish break of structure, and then a full retracement in which we start to see higher highs and higher lows, higher high, higher low, higher high, into our final supply zone, which lines up with a resistance level. Now, what we see is price making a higher high, a higher low, a higher high, and then returning into a demand zone. So now if it's returning into a demand zone, it's actually providing an opportunity for us to look for a sell to take out that liquidity. That liquidity is a demand level and it's also a support level right here. So you can see it's no surprise that price had a massive push down through this level. But how do we actually find a trade here? If we jump down into the hourly time frame, this is where we're going to start to see some more price action. So what do we notice? We tap into the demand zone and we do a bullish break of structure. So from this low to high, we now have a bullish range. What does that mean? We understand there's a lot of traders that are getting into buys based on that bullish break. You can see if we pull out the Fibonacci that we have right here, price tapping into our 0.618 retracement, which is generally considered the golden zone of a retracement for traders. So now we have the 6.8 retracement. Let's jump down into the 15-minute time frame and see if we can find any other confirmations here. So now that we're in the 15-minute, I'm going to remove the Fibonacci just to clean up the chart a little bit here. Now that we're in the 15-minute time frame, we have this big push up, which we identified on the hourly. Price started to then step down, making lower highs, lower lows, lower high, lower low, boom, bullish break. So now we have the 15-minute to a minor bullish break after coming into our demand zone plus a support level. Great. If we're identifying that Everyone is going long. How do we jump into a short here? One final confirmation. There's a couple things. When we have that small 15-minute bullish push, we can then identify again, we can pull our Fibonacci out one more time and see that we've had a 61.8% retracement. That golden zone is reached. Traders are starting to get into a buy. But what will be the final confirmation which allows us to get into a sell? This is identifiable on that 1 minute time frame. So if I jump down into the 1 minute, here it is, and it's a bullish break of structure. That bullish break of structure leaves a demand zone right here. So what we can see is when price makes that bullish break, gives a wick above, and then pulls back, we can then enter a sell for a short. Once we get into that short, which is right here, you can see that the stop loss is placed where? Above the liquidity. We have this small trend line liquidity here, which price could have come and swept. So I've just covered this high with a stop loss just to be safe. Now I go for a 1 to 2 risk to reward ratio. Once everyone is trapped into a buy, you can see that price just begins to melt down. Melt down, continue, make that 1 to 2. And not only that, but if we actually look at the 1 hour and the 4 hour, we actually go to finally take out that whole level. There we go. So not only could this be a 1 to 2, which aligns with my strategy, that's all I like to go for, but we could have actually hit a nice 1 to 6 on this, and that's a valid trade. Again, risk management is going to be different for everyone. For me, I just like a quick 1 to 2. This is a beautiful trade example how going against the herd makes you the most money. But guys, I want to thank you so much for watching this video. AJ Currency, and I'm going to be showing you a lot more, which I'm very, very excited for. So let's get into it, guys. I hope you liked it. If you did like it, make sure to like, comment, and subscribe, and I'll keep these videos coming. Thank you so much.